If you change that Fed funds rate, you would do a number of things. They like to talk about anchoring inflation expectations. Now, most people, by the way, don't understand what's going on. And that, when I say most, I'm talking about people on Wall Street. People on Wall Street think exactly like Trump, and they think exactly like the chairman, Powell, in principle. That is, a focus on the interest rates. So if the interest rate would be dropped by 3 percentage points, you would have an unanchoring of inflation expectations. Everyone would start thinking that inflation was going to be going up because they don't pay any attention to the money supply, but their expectations would change. So that's one thing that changes, and that would not be helpful, by the way. The other thing that would change is the dollar. The dollar would get weaker. The president drafted up a letter and made it public that he wants to get rid of Powell. This is nothing new. He's been beating this drum pretty hard for several weeks. I would say in this case, although both personalities get a letter grade F from Hanke, I hope Powell stays the course. And the reason for that is that this again would throw tremendous regime uncertainty into the picture and be very destabilizing, because the next person going in, you know, they're going to be a hack of President Trump. There'll be someone that Trump thinks he can dictate monetary policy to. So you'd basically have Trump running monetary policy, which is, you need that like a hole in the head. You want to keep coming back and focusing on the Fed funds rate. And I'm saying that it might be a second or third order condition, but the first order condition is what's going on with the money supply. So how do you deal with that? The first thing to do is to stop quantitative tightening, stop shrinking the Fed's balance sheet. And the second thing to do would be to announce that all of a sudden, Powell's got religion. He's embracing the quantity theory of money. And he's decided he's following Sakurki and Hanke's book, Making Money Work. He's adopted the quantity theory of money, and he realizes that we have to get the money supply growing again. And the best way to do that is to stop tightening. He's tightening now with the quantitative tightening. Well, what happens is that the money supply starts growing at a more rapid rate, and with a lag, then that works into the economy. Remember, with a lag, it's not like walking in a room and turning a switch on. These things take time to work themselves through the economy. I mean, the inflation we're witnessing today is a result of what happened to the money supply a couple of years ago. And of course, that's another reason people get confused. They're data dependent. They look at the data today and they try to interpret, well, what's that mean? You know, they got their finger in the wind. What's that mean? How do I interpret that? They don't realize that that's a symptom and something that was caused by what happened to the money supply a couple of years ago, because they never look at the money supply. It's not on their radar screen. So all the interpretation of everything is just wrong. For the last 30 years, we've had economic theorizing at the macroeconomic level that's focused on what they call post-Keynesian models. Actually, believe it or not, Keynes paid a lot of attention to money, especially in his 2-volume treatise. This was before he wrote the General Equilibrium. The treatise was all money. So that was Keynes, and even in the General Equilibrium. So the Keynesians, of course, trashed monetarism and money and kind of slid out of the picture, and they just focused on fiscal policy, not monetary policy. And that was the domain of macroeconomics. And then we had Friedman in the 70s brought monetarism back in a kind of a counter-revolution. And then for the last 30 years, we've had another counter-revolution, and that is post-Keynesian economics. And the post-Keynesian economic models, those macroeconomic models, they don't include money. There's no aggregate measure for money, like M1, M2, M3, M4, whatever M you want. It's just not in the model. So that is one reason, by the way, that Powell, who's not an economist, he is advised by what? His research staff at the Fed. They have a huge research staff. And the Fed system, I think they've got around, between 750 and 800 economists. But almost all of them are reading from the same song sheet, and that's these post-Keynesian models. So that's how it disappeared at kind of a theoretical level. It disappeared from central banks as a political thing because central banks are supposed to be in charge of monetary policy and the supply of money. And if something like inflation raises its ugly head, they don't want to be blamed for it. They don't want to be connected with any changes in the money supply that might have affected inflation. So they want it out. In other words, they want inflation always explained by some non-monetary factor. So you can't blame the central bankers for anything they're responsible for. It's always the supply chain, the oil prices, the this, that, and the other thing. That's what causes inflation, not changes in money supply. So you've got two things going on that are kind of complementary in a way. If you inject money into the economy, Matt Sakurki and I argue that one objective of monetary policy shouldn't be just stable prices, but it should be neutrality. Now, what the money supply should affect as much as possible individuals and sectors of the economy in a neutral way, not in a distorted way. Now, let me give you a very concrete example that drives this home. Because what I just said is kind of theoretical, stuff for the high priest of economic theory and so forth. But let's talk about it in terms that your viewers can understand. And that is, when the COVID hit in February of 2020, the Fed goosed the money supply. Now, that goosing was not neutral. It affected different classes of people in very different ways. And one thing that happened, once the money supply was increased and goosed, asset prices dramatically went up. Real estate prices went up. Yes. The stock market went up. Yes. Land prices went up. All of this. Now, who owns the assets? Well, rich people own assets. Poor people, even middle-class people, don't own many of the assets. So you had a non-neutral impact on the distribution of income. People who were billionaires made out like bandits. In January of 2020, right before COVID, the wealth of billionaires in the United States amounted to 14.1% of GDP. Today, that percentage of wealth of the billionaires as a percent of GDP is 21.7%. So by being non-neutral, the Fed has created a huge income inequality in America. You don't want monetary policy doing that. You want to design things so they're neutral. Now, obviously, one way to do that is to have a fairly steady and stable growth rate in the money supply. Hanke's golden growth rate of 6.3% using M2 as a measure would be consistent with an inflation target of 2%, and it would be a hell of a lot more neutral than what Powell was engaged in. That's another reason, by the way, I'd give him an F. One, people have to stop thinking about interest rates being monetary policy. Monetary policy, it changes in the money supply. That means the quantity theory of money. So we get the quantity theory of money back in the picture. Now, who produces most of the money? Commercial banks produce about 80% of broad money. So we want commercial banks and the policies that affect commercial banks back in the middle of the picture. And then we also throw in the potential impact that changes in fiscal policy have indirectly on monetary policy. And the last thing is this neutrality thing. All those things are new, basically. All those things would change. The quantity theory of money coming in, that changes the fundamental theoretical model used to analyze the thing and think about the thing. And then the importance of commercial banks and their bank regulations and how they affect commercial banks and how that affects the monetary system. That is the second thing. Then the third thing is throwing the fiscal policy into the picture and how that dovetails and relates to monetary policy. For example, in the COVID period, we had a huge impact in the increase in the fiscal deficit, and 90% of that was actually monetized by the Fed. That's why the money supply grew so fast. So we have that in the picture. And then lastly, we've got this new thing of you want to have neutral monetary policy. You don't want a policy now where the Fed pays no attention to neutrality. It's like the money supply. The money supply is not in the picture now. And neutrality is also not in the picture. We want those things both put in the picture. When you save, you don't consume, you wait. That's my other book that I wrote with Leland Yeager right before this Sakurki book is called Capital Interest in Waiting. So why do you save? Why do you wait to consume? Because you get paid an interest. If you weren't getting paid interest, you'd consume everything. And you save because that savings gets intermediated and gets into productive projects in the economy through not commercial banks, not deposit-taking banks, but through investment banks. That's the channel the savings goes through. Now, the commercial banks are different. As you indicated, they can create money out of thin air, credit out of thin air. And when they do that, that new money, that goes into bankable projects too. Now the real interest rate actually has gone up to about 1.7% or something like that. And I think it probably will go up to, like 2.5 or 3%, something in that zone. So you can't run an economy very long if real interest rates are negative. That's an anomalous situation. The equilibrium in the economy dictates that you have to have positive real interest rates. Otherwise, savings and waiting end up withering away. And if they do, of course, you have less finance going into good bankable projects. The economy slows down. Productivity slows down.